Hello everyone, it's Alex Suslov, Head of Capital Markets, here with you for our AD Weekly Digest. Today, while Trump's Mar-a-Lago residence is being under FBI investigation, we're talking about market news and mortgage updates for the past week. We saw in the past quarter some lenders were turning off their wholesale business. Some people went out of business completely due to tight margins and losses in Q2 and Q1. Some lenders were cutting their programs and eligibility in the past months due to reduced demand from investors on the market. All these changes to programs were mainly due to investors being less active due to federal Fed funds increasing throughout the past couple quarters. Today we see some improvements on the market with securitizations going much better and more investors buying bonds. So long story short, we see positive move over there from the standpoint of the buyers who are going out and purchasing bonds and mortgage loans. In the past months, we saw lower gas demand, which has influenced lower oil prices. And as a result of that, we saw lower CPI numbers for the past months, which came at 8.5% mark, down from 9.1% in the previous. And we have Billy, CEO of ADM Securities, here with us today as always to give us a better overview of the economic numbers and what data to pay attention to in advance of the Fed meeting and the expectations for the Fed funds increase in September. Hello Billy, how are you?
Sure, Alex. For me, this week was all about inflation. We got numbers on CPI, PPI, import prices, inflation expectations going forward. Every one of those numbers came in better than expected, meaning lower than expected, market friendly. And yet, as the markets approached the close on Friday, virtually every yield on every treasury was worse than it was, higher than it was a week ago Friday. The fireworks started on Wednesday when CPI came out. Within 3 minutes of the release, the 5-year had rallied 25 basis points. Traders run from losing positions much faster than they enter new ones. 25 basis points in 3 minutes tells me that was a short covering rally. And to address something you brought up about energy prices and in CPI, there's nothing about CPI that excludes energy. You can't put goods on the shelves of stores without fuel costs. Service people can't drive to work without the cost of fuel. And my point is, going forward, as we think about inflation, we're still looking at a time when there's a war going on in Ukraine, which puts upward pressure on crude oil. We're entering the heart of hurricane season. The recent years have seen the most damage in this country done in the Gulf Coast, the region where all the refineries are. Again, upward pressure on crude oil. We're currently $1 off recent highs in gasoline and almost $50 off highs in crude. Right now, betting that energy prices will not go back up is probably a risky bet. In about 6 weeks, the Fed will meet again and they will raise rates again, and more than likely we'll be talking about a 3% Fed funds rate. The coupons further out the curve don't have to yield more than Fed funds, but most of the time they do. It is most likely that they will, and I would look for 5 and 10-year yields to be back in the 3.25 range, maybe a little higher by the time the Fed meets again in September. I do think there's another rally coming this year. Technically speaking, just to cut to the chase, if the 10-year sees a trade at 292, I think the next 15 to 20 basis points will come pretty quickly. With that, I will kick it back to you, Alex.
Thank you, Billy. It was a great overview as always and very helpful to our audience. Thank you everyone. It was Alex Suslov, Head of Capital Markets at AD Mortgage with our AD Weekly Digest. Stay tuned and make sure you sign up to our YouTube channel to stay on top of most recent market news and watch AD Weekly webinars. Also make sure you sign up to Billy's market updates that he sends out every morning. I love those. Those are outstanding.